Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Scott Kefer, Senior Portfolio Manager at VictoryShares and Solutions, to discuss the next generation of innovators. Scott, welcome back to Trade Talks.
Thanks, Jill. It's good to be back.
While the Nasdaq 100 index includes many of today's leaders in innovation, your firm recently launched a strategy that focuses on the next generation of innovators. Can you tell us more about that?
Sure. So yes, last September, in partnership with Nasdaq, we launched the VictoryShares Nasdaq Next 50 ETF. The ticker is QQQN, or you'll hear me refer to as triple QN. And the Next 50 ETF, it tracks the Nasdaq Q50 index, which represents the 50 securities that are next eligible for inclusion in the Nasdaq 100. And the Q50 is going to build off that same focus of innovation and growth that the Nasdaq 100 has really long been known for. But by looking to the next 50 eligible securities, it's trying to recognize these disruptive companies earlier in their life cycle. So while the Nasdaq 100 is a who's who of some of the most successful and some of the most innovative companies in the world, you can think of the Q50 as representing the up and coming companies, companies that sit right outside the cap range of the Nasdaq 100. Companies that have the potential to be the next great successful innovative companies. And importantly, this index dates back to 2007, and many of the stocks you likely consider today to be staples of the Nasdaq 100, well, they first started as constituents of the Q50 index.
Now, the methodology for Nasdaq 100 and Nasdaq Q50 seems very similar. Are there any key differences? Can you elaborate on that?
Yes, they do share a lot of similarities. The Q50 index really shares a lot of the same time-tested methodology as the Nasdaq 100. The shared methodology is what keeps it, the Q50, and therefore triple QN, aligned with that same focus on innovation and growth that the Nasdaq 100 has become so famous for. So both start with it's a very simple three-step process. They both start by looking at all companies, foreign and domestic, that are listed on the Nasdaq Stock Exchange. Next, anything classified as a financial is removed. And then the remaining companies are sorted by market cap. And quite simply, the largest 100 are going to form the Nasdaq 100 index. And the next 50 largest form the Q50. And then both indexes use cap weighting to determine the position size. But as you point out, there's one important difference between the two. And that is that the Q50 is going to reconstitute every quarter, while the Nasdaq 100 only does so in December. And that Q50's quarterly reconstitution process really has two important advantages. First, it's going to provide the Q50 3 extra opportunities every year to add the next great innovator. And as we know, and as we witnessed last year in particular, disruption and innovation, it happens very, very rapidly. And sometimes a company can reach the Q50's market cap range in less than a year, very quickly. So having that extra 3 times a year to reconstitute, and the Q50, it really doesn't have to wait until December to add these names. It has those 3 extra opportunities. And then the second benefit of these quarterly rebalancing is that the Q50 has those extra opportunities to remove underperforming names more quickly as well. So it's, remember, simple process. At each quarterly reconstitution, the Q50 is going to look at the largest 50 non-financial stocks listed on the Nasdaq exchange that are not already in the Nasdaq 100 index.
Scott, how about concentration in the strategy? Since this is a market cap weighted index, does that mean one stock might get more preferential treatment than the other? How do you think about it when it comes to concentration risk?
Yeah, no, the Q50 index does not have that same level of concentration in the top holdings as the Nasdaq 100, but you're right to point that out. Clearly, again, as we've experienced over the last few years, concentration can be rewarded in certain market regimes, but arguably, we've really been reaching extreme levels. At the end of 2020, the top 3 stocks in the Nasdaq 100, so Apple, Microsoft, and Amazon, they combined to be almost a third of the index weight. And the top 10 in the Nasdaq 100 were almost or a little over 50% of the index weight. But the Q50, on the other hand, because it doesn't hold those mega cap names, it has a much more normal distribution of position sizes. The top position in the Q50 at year end was about 4%. And that compares to Apple in the Nasdaq 100 at about 12%. Even the smallest position in the Q50, because of that normal distribution, it still has a meaningful 1% weight. So any of the 50 constituents has that potential to be a meaningful contributor to the total return. So we've seen a lot of interest in triple QN from investors who are looking for that same exposure to innovation, that same exposure to the growth that they benefited from by investing in the Nasdaq 100, but without the mega cap concentration. And while triple QN is going to give you a little bit more of a mid cap style exposure, it's important to note that these innovative companies are not so small or so early in their life cycle that they're sort of speculative. These are still companies that are large enough. They have established business models, but they're often really just reaching that inflection point in their growth trajectory where they're truly becoming disruptive.
Scott, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.